Welcome to Multiple Perspectives. I'm David Lofgren. Co-hosting the show with me today is Equity Multiple's Senior Director of Investor Relations, Daniel Brereton. Daniel, welcome back.
David, always happy to be on.
So much of the work that you do at Equity Multiple is helping investors navigate the landscape of alternative assets. You know, a class of investment that most people who are exploring personal finance are aware of. Most of us have heard of stories about venture capitalists or, have a friend who's done some real estate investing. But it feels like when it comes to actually adding alternatives to one's portfolio, it can be a pretty daunting process to try and unpack all the facets of what can sometimes feel like a niche investment market. But you spoke with someone for the podcast who, years ago, and like yourself, has spent a lot of time trying to help people understand how to pull back the curtain, right?
Yeah, totally. I think, speaking with Daniel Holmlund of Alternative Investing Club, he hones in on the right aspects, hearing his story, how he came up as an engineer working at Intel, and really what he's always tried to do in his career and, in his community is connect with people and build community. I think that's one of the biggest portions of investing, both on the investments side, working with real estate sponsors, and also on the investor side and building trust with investors. And I always talk with investors about investments, especially real estate, alternative investments and real estate in particular, as being very people-oriented business. You're trusting a sponsor, you're building houses, physical commodities for tenants. You're building houses or industrial spaces for industrial tenants and those businesses that need a physical space. So you're always dealing with people and brokers, and it's a very community-oriented asset class. But that's on the asset side or the investment side. Even on the investor side, I think that people relationship sometimes gets ignored. Obviously people think about sales or, talking with people to sell an investment, but what I speak to investors about is trying to build trust and trying to build community in the alternative investment space. And I think that's what Daniel Holmlund has done with his club is, building a community and building a network of investors who, from the lowest levels of knowledge about alternatives, always to seasoned investors in several different types of assets, and trying to build that connection between people to learn more about it, fill their knowledge gaps, and really, dive straight into the world of alternative investments.
Yeah, that's right. I mean, as we'll hear, I'm sure, Daniel started this Alternative Investors Club, I think at Intel initially, right?
He did. Yeah, he started it as not a pet project, but a club. They had, special clubs for everything, and they didn't have one just for alts. They had one for stocks and bonds and mutual funds, everything else, but they didn't have one for alternatives, and he started it. I think it even started as a real estate investing club and, broadened to alternative investments as alternatives became more mainstream.
Well, we're lucky today on Multiple Perspectives. We all get invited to the Alternative Investors Club. I can't wait to hear what you guys talk about.
Let's take it away. Daniel Holmlund, founder of Alternative Investing Club and Grow Your Business with AI. Welcome to Multiple Perspectives.
Thank you for having me here, Daniel. It's good to be here.
Yeah, as we're switching spots. I was on your podcast not too long ago, and we've done some webinars together, but now we get to turn the tables a bit, and you get to be in the interviewee seat this time.
Isn't it kind of confusing having two people here named Daniel talking to each other?
Yeah, we got to come up with some sort of code name, exactly. But I think it'll be a great conversation. Hearing more about your journey, right? You came from being a tech leader. You still are a tech leader. From at Intel, founding an alternative investing club, working on consulting in AI, especially as AI has been such a boom. Can you just walk us through, a little bit of that journey? Like, how did you get from on the tech side and working at Intel over to now alternative investing club and consulting in AI?
Yeah, it really started because real estate has been in my family, and engineering has been too, actually. The aha moment for me probably came actually in college, and it was because of one of those younger life experiences that I had. My grandfather on my mom's side worked for a company called International Harvester, and he was a tractor repair person. He fixed tractors, he did farm equipment maintenance, and he retired at 65. And when he retired, my grandma, who is the financial wizard between the two of them, decided, hey, for our retirement, let's go buy this 120-unit apartment complex with your brother. We'll create a partnership to own it, and we'll just fix up the units in our spare time in our retirement. And that's how we'll pay for our retirement. And so they went and did that, and they actually passed away when I was about 10. So this is the childhood experience that I had, is that I saw my parents on the phone, and they were forced to sell the apartment because we couldn't pay the property or the inheritance taxes on the property. And so I got to see my parents on the phone with lawyers going through, tons and tons of calls, lots of statements, lots of headaches. And I thought that was it. I was actually really interested in that at the time and asking a lot of questions, even though I was young. But it honestly wasn't until later, probably in college, where I realized my grandpa worked his entire life until into his 60s. And it was only then in his 60s that he purchased real estate and then had something to hand down to the next generation. His job in farm equipment maintenance paid the bills while he did it, but it didn't leave anything for the next generation. It didn't create a legacy of wealth. And my parents had an inheritance because after he retired, my grandma, grandpa, and my grandpa's brother did that.
Yeah, it's that wealth building. And, I speak to a lot of investors, and I think that's what motivates people, is having that legacy. I was working at UBS, same thing. But I guess more specifically, was there anything about your engineering or your tech background that you've been able to join forces on the investing side? Is there anything there that gives a bit more edge when it comes to evaluating investments?
Well, I mean, lots of engineers are good with numbers, and that's honestly where my strengths are too. Not really in marketing. But I love looking at deals. I love doing the underwriting. I love evaluating markets. And I like the idea of ownership. I think that every person should have a culture of ownership, building their own assets up and creating their own revenues based on their own assets. And so what I did is I was working as an engineer at Intel Corporation, and I had been there for a number of years. And I decided I'm going to start building a real estate portfolio. And I'd actually dabbled in it and done a couple of house flips. And back right when I came out of college, back in 2001. And I actually did hard money loans for about 10 years, going all the way through 2008. And that's an interesting story when your hard money, when your property owner calls you up and says they're not going to pay the mortgage. I could go into that story if you want. It's fun.
Yeah, I think it really highlights, the journey a little bit more too, right? Doing it doing it yourself, and now, trying to find others to manage it for you, right?
Yeah. So in 2006, my wife and I decided that we were going to go overseas and be part of a volunteer organization. And the way that I supported us, we did raise some send-off capital from organizations that were willing to sponsor us. But one of the other ways that I supported us is through hard money loans. And so I did that remotely, actually, from France, where we were working with the French and South African French. And we did appraisals of properties, and I would have I had a rehab guy that would go and buy the property. I'd provide him with 80% of the capital. He'd purchase the property, he'd do the fix up, and then he would pay me off at a 6-month balloon loan. And so the 6-month balloon would have 15% interest, 1 point. I could have probably charged more there. But it was a good way of just sending out capital, getting a good return on it, and having it come back on a regular basis. All the way until 2008. And in 2008, I was overseas, so I didn't really realize that the market was crashing here in the United States. But suddenly I couldn't get a hold of my rehabber when I called him on the phone. I was like, I'm just getting nothing.
Yeah.
Maybe it's,
he ghosted
I don't know
you.
what's going on.
Yeah.
Yeah, he ghosted me. But after about a month, I finally got through to him. And he said, hey, Daniel, that loan that you gave me, I've got multiple houses that are going into foreclosure. I'm not going to pay you back. And I went, really? So what are we doing about that? Are you going to deed me the house, or am I going to bring you through foreclosure? And he said, Daniel, I know the markets over here better than you do, and you're overseas. It's going to cost you 11 grand and 12 months to go through the court system here. I could deed it to you for that amount.
So you picked
so
up.
You could have it today,
what was
if
that?
you.
Yeah. What was that pickup? He's paid $11,000. What was the house actually worth? At that time.
The house was worth about $180,000. He purchased it for around $130,000 or so, if I remember correctly. So I had around $100,000 loan on this house where I wasn't going to get that back. And he, instead of, deeding the house to me, basically blackmailed me for the money, saying it's going to cost you that much to drag me through the court, skip the headache of that, and just pay me the amount you're going to send to the court. So I set up an escrow account, and we did it through a lawyer, and we did an exchange. And I ended up to the deed to a property in Florida where the market was crashing, and I was overseas. We actually got a property manager and rented that property out for the next 7 years, and the market returned, and it ended up being more than what we paid for. And we got rent mortgage free for that entire 7 years. So it wasn't a bad loss on my end. It was just the disappointment of, first of all, not knowing who my partner was until things got rough. Lesson number one. Many partners don't really show their true colors until things go badly. And then lesson number two is make sure you're in a position where if things go sideways, you can recover your capital. And that's what I did there.
Yeah, I mean, it's a great baptism in alternative investments. And I think a lot of investors, there are these big boom and bust periods. Obviously, the global financial crisis, the '08 crash was one of the biggest ones, people taking multiple loans on properties. But we also had a recent one during COVID. People got really excited about flipping houses again, that BRRRR method that people have been putting in. And I think a lot of people got burned or got really underwater when rates started to rise. And, I think that leads to a lot of interest in alternative investments, and people want to do it themselves. They think they'll save a lot of money, but as you might be aware, you end up losing some money in a lot of ways. But there's this huge growing interest in alternative investments across the board. I think you started with real estate, but now you've expanded into all sorts of different asset classes, especially among self-directed investors. But across the board, private credit is really blowing up. How does this align, do you think, with broader shifts in the economy? What do you think is driving that interest in alternative investments overall?
I think people realize that stock market evaluations are very inflated right now, even though people are continuing to put money into the stock market. People realize that asset prices are overvaluated right now, or at least they have been rising on a consistent basis. I think there's a very good argument to be made that they're going to continue to rise, both in the medium and the long term. But part of what drove a lot of the diversification of those alternative assets was the interest rates going up so much during COVID. I mean, we were getting free money, basically zero interest loans or close to zero interest loans, 30-year mortgages. I locked in the mortgage on my house at 2.6%, annually. And the idea that you shouldn't have any debt is something that you need if you're in credit card debt or if you don't have that investor's mindset. If you have a real estate investing mindset, debt that is cheap is a gold mine. And in fact, you're never going to save your way to riches, but borrowing and leveraging that debt in order to buy hard assets that provide regular cash flow is one of the most surest ways of becoming wealthy. Andrew Carnegie said that 85% of millionaires are created by real estate. And it's true. And so what I did when I was an Intel engineer is I decided I was going to build my real estate portfolio, specifically because I saw that the economy was on a knife's edge, that if interest rates went up, things were going to collapse. And so I wanted to buy assets that would be inflation resistant. And that's specifically where I wanted to put my money. And so in 2018, I founded the Real Estate Education Club at Intel. And I literally went to Intel HR and said, I see you have a stock club. I see you have a startup club, and I want to run the real estate club. And we went through all the paperwork to do it. And it was a non-solicitation, education only, environment. So we invited speakers to come in, every Friday at noon. And I'm really proud of that track record. We have maintained that track record for the last 6.5 years, where we've been averaging 47 to 48 events per year. We usually don't do right after Thanksgiving and maybe one or two in December, but otherwise we have an educational speaker that's focused on investors every single Friday at noon. And now that we're outside of Intel, we rebranded that the Alternative Investing Club.
There it is. Yeah.
And so it's the same group.
Yeah, I was curious about that. Yeah, you've got this lifelong education, this lifelong wanting to share this this knowledge that you have, and part of that is just the community that you've built, and curating the speaker list. What does it take to bring that those curated sessions to your members, and I guess vetting the members that you bring on, or vetting the managers that you bring on?
One thing that it takes is you really have to have a passion for digging into the investing community and finding the people that are good speakers. And so I do a lot of podcast listening. I listen to a lot of webinars. I keep myself in the community to understand who's who. But then after that, I rely on recommendations from other people of who is a good speaker. And what I normally do is I will set up a call with them ahead of time to do a podcast interview like this, where we'll record for 20 to 30 minutes. We broadcast it on social media, and it's my opportunity to get to know them. Once that happens, we bring people into the club in one of three ways. The first way is a pure educational talk where they come and they simply share about the strategies that they use in their company. And they can leave their contact information at the end. And anybody in the club who wants to is free to contact them. And the club itself has no part in that, in their relationship thereafter. The second way that we bring people in is once we exited from Intel, we were allowed to start performing commercial services. And the club actually came to me and said, Daniel, we're getting great education, but if we want to find a deal to invest to, we have to go look at other clubs. So we started bringing in pitch talks. And we try to do that, usually once a month or so. But it depends. It could be twice. It could be zero. But we keep it at about that ratio where we have pitches and educational talks. And with the pitches, the Alternative Investing Club is not a part of the transaction. We're not a registered investment advisor, and we don't recommend the group, the people that are there speaking, or not recommend them. We simply think that they would fit with the club's investor appetite, and we give them a platform to present on. So, and then the third way that we bring people in is as a club fund speaker, and that is I've personally reviewed, the fund. I think we have a club fund, the Alternative Investing Club Fund, and it fits with our core value of providing paths to opportunity to our members. And so we will usually look for institutional or semi-institutional deals that have $100,000 or $200,000 minimums. We bring the speaker in to present to the club, and we say that they're a club fund speaker, which means that at the end of this, the club will send out a call for capital. And if you invest in our club fund, we will earmark that to go to that particular speaker. And so it's a way of giving the club members a voice in the fund because they can determine what percentages are allocated to which speakers by the response that they give. And so it's very interactive. We send out the call, we collect the money, and then place it with that particular operator. And it's part of our community to be a community of learning, community of providing paths to opportunity, and of just growing our portfolios together.
Yeah. It's a lot to go through. I guess more on a very down a deeper level. I guess with these investments, how are you approaching risk? Right. There's a lot of alternative investments out there. Which investments have you seen work really well? Like, what are the green flags, I guess? What are the red flags for investments? And, how have you looked at that across your alternative investing career?
Yeah. So first of all, we do have a large, checklist due diligence bullet point that we bring all the people through that they have to qualify in order to be a club fund speaker. But some of the lessons learned, just because you're a large operator doesn't mean that you won't fall flat on your face when market conditions change. I think that was very well illustrated here when interest rates went up. We saw a lot of people who were on bridge debt or construction loans suddenly unable to meet their debt obligations. And so the first and foremost, the first pillar of risk is the sponsor and their track record. You have to know who they are, You have to know that they have a team. They're not just, three guys. And you have to know that they have multiple deals that they have successfully completed before in the past. If a person actually has a failure in the past, say they have an investment that hasn't done well, I want to know why it hasn't done well. And sometimes there are learning lessons, and you understand that, okay, they did that and they've pivoted from that strategy. But understanding the sponsor and their track record is the first and foremost in a deal. I could go through the other pillars really quickly. Are understanding the market, understanding the property, understanding the regulators, and understanding the investment opportunity. And we'll usually go through and categorize each of those. I'll let you jump into wherever you want there.
Yeah, I guess, for me, I always like to, hear more specifics. Was there a specific deal that you were in, or a specific sponsor that really highlighted the importance of track record? Or, I guess a lot of investors, in my experience, they don't like to see losses. They don't like to see a sponsor they expect sometimes perfection from sponsors. But you make a good point about pivoting and learning from your lessons. I guess, what's the best lesson learned that you've seen?
I want to bring it back to the interest rates going up. I saw quite a few coaching groups go completely bust. And they were coaching students, and they were taking out bridge loans on multifamily properties. And a lot of the coaching industry, I've become personally very wary about, because they'll bring people into deals, and specifically if their fees are higher, or if they're doing their deals simply to accrue fees and they're not interested in the matching their outcomes with the investor outcomes. And all of these people will talk like they're interested in that. But in order to actually understand that, you have to look at the legal papers and understand, are they actually aligned incentive-wise, where if the LP profits, the GP profits, or the LP profits before the GP profits. So one big lesson was interest rates rising quite a bit, seeing people that had variable rate loans not be able to afford their debt, seeing debt caps expire, or having inadequate insurance. Those are some areas to look at specifically.
Yeah, it's important to be thinking about the risks and learning from it. I'm sure that you've learned a lot over your decades investing in various assets, public market assets. I think people understand a lot about the different risks in diversification with different stocks and bonds. But with real estate, I feel like a lot of people, since it is such a chunky asset class, right? It does take a lot of capital to be in one building. They tend to get very concentrated. But how are you approaching it, especially now with different types of alternative investment platforms available and products? How are you approaching that in your portfolio with diversification and risk?
So our club actually came to us. First of all, I take direction from the club. I do a lot of polls with the clubs, and I try to understand what people are looking for. And they actually came to us and said, we want to diversify outside of real estate. And so we started bringing in speakers. We have a really interesting lineup of speakers coming up. We have one group coming up that does debt validation. And what this is it's specifically, I love this group because they're specifically aimed at firefighters, first responders, and veterans. So first responders and veterans. And what they do is they find first responders and veterans who have unpaid health bills that they just have on their credit cards. And they go in and purchase that debt. And they can usually get that debt for, I'm just giving a really quick overview of their model here, but they can purchase that debt for 30 cents on the dollar oftentimes, restructure it with the first responder so that they don't have a 30% credit card rate like they would with a credit card, but it's more in the area of no interest or 5% interest, a very low interest rate, and create a 2-year plan to help them pay it off. But the money is made being able to buy that debt at a reduced amount because the previous creditor wasn't receiving anything for it oftentimes. So it's the idea of going in, buying a loan, resuscitating the loan, and using that in order to provide your investor return. And this group provides 20 to 25% cash flows paid out on a quarterly basis at the same time that they're helping first responders get out of debt. So real estate is, frankly, a great way to build wealth, but it's not the only way. We have another group. We've gotten into oil and gas partnerships. I think other people have talked about those before, but you buy an oil well, pump it out of the ground, and split the profit, right? That's the basics of it. We have another group that's coming in that's going to be talking about airline equipment leasing. How do you create spreads by buying airline equipment and leasing it back to major airlines? And so really what the Alternative Investing Club is all about is helping people to realize there are a lot of fascinating ways in order to be involved in investing that helps communities and helps, families and helps groups. We want all of our investments to be something that is beneficial to a community or a group, not beneficial to Wall Street. Or at least we're working within a community instead of working within Wall Street. So we really focus on investments that are community-based investments or have a purposeful investment criteria. And we'll interview speakers. The speakers come in. The club lets us know if they like them or not.
It's interesting that you mentioned about building better communities. I speak with some sponsors too on the real estate side who, they want to see this as building something better, not just speculating on land,
Absolutely.
not just speculating on property, but they want to build up a community, bring it to its highest and best use, as a lot of people in the real estate industry say, and provide an attractive return on the flip side of that, right? I think that you can do good and get good returns. And you mentioned about cash flow from different loans and cash flow from different financing methods. And I think a lot of people see real estate as just equity, but I think a lot of people wouldn't know that you can also do real estate lending. You started as a hard money lender yourself. I guess, how do you see picking different real estate transactions when someone's looking for cash flow or growth, or what you might consider with picking a deal on the real estate side?
I think you really have to know your investor. And so anytime you bring an investor on, you need to have a sit down, 30-minute minimum call with them just to understand where they're coming from. Understand, are they looking for cash flow? Are they looking for appreciation? Is it to help them retire? Maybe they want to send a kid through college. You really have to know who your investors are. And I think there's been a stronger pivot in the market here towards cash flow being important, because a lot of people have been promised growth at the expense of cash flow, and then it never really maybe came to fruition. And so people are making sure that the deal is solid by being able to provide cash flow up front. I think a lot of investors are looking for that currently right now.
Yeah, it's. I think we saw that a lot with the drop in interest rates. Over the super long time of zero interest rate policy, where no one was getting yield anywhere, so they were looking for yield elsewhere. But even now, yeah, I guess, is that what you're seeing with your club right now? Are they looking more for growth opportunities or income opportunities?
It's a mixed bag. It has shifted more towards the cash flow over growth. If you give people the choice of would you prefer cash flow, growth, or both, they're always going to choose both.
Yeah. Everyone wants the best of both worlds, of course.
Everybody always says both. But you really have to you have to try to create a balanced portfolio. In the Alternative Investing Club fund, we're targeting specifically cash flowing assets, and then growth is a secondary but important goal. So we want it to cash flow first, but we also have growth as part of it. So we're a hybrid approach, and to what extent it's hybrid really depends on how much the community people decide to allocate with each operator we go with.
Got you. I think, that actually underscores one of the things that I want to talk about, which is maybe some misconceptions with investing in alternative assets, and specifically about real estate investing. You mentioned people want to see cash flow. They might just be focused on that cap rate, the capitalization rate, the yield that they're going to get from this thing. And they think if they buy it, they're just going to get the that yield. But obviously Murphy gets in the way. What other misconceptions would you want to address when it comes to real estate investing specifically?
I think a lot of people don't realize that in most real estate investments, the majority of the investment is realized at the time the property is sold. I think a lot of times I've seen over expectations of of what cash flow looks like, and particularly if you graph out the return of capital and the return of investment on different opportunities, what you realize with real estate is that a lot of it is very growth oriented rather than cash flow oriented. Cash flow can be 6, 7, maybe 8 or 9, 10% usually, with a 12 to 15% or higher IRR depending. And so when you see numbers like that, one thing a lot of people may not realize is that 90% or more of that income is going to be happening at the back end of the deal. And so I think that's an important investor misconception, that it really, usually a good chart really helps to illustrate that. There are other misconceptions that we've seen. I think a GP misconception is what it really takes to communicate with investors. The number one thing that I've seen that's led to growth in our club is just simply being consistent. Having, a meeting every single Friday. I've had weeks where I haven't even sent out, the regular invite, the regular weekly invite, and the whole group shows up anyways because they know where it's going to be.
Yeah.
And so setting expectations like that with your investors are really important, and then making sure you actually stick to them.
That's a great point. I often talk about how real estate is such a people business, right? It's you don't just buy a ticker moving up and down on a screen. You're not just lending money to nowhere. It's syndicated away and cross collateralized in a million different pieces. You're buying a real asset. You're lending to a real person. So yeah, the consistency. It's a great thing to bring up there. And I really think want to hark on how much of a community that you've built. Have you seen that same side of real estate being, such a person-oriented or people-oriented business?
Oh yeah, it's completely people-oriented. One thing that really encourages me in running a club is getting notes of encouragement from the community. I actually keep a document where I save all of them, and if I'm ever having a rough time, I will go and read them. But I have people that have sent me notes saying, hi, Daniel, I've been attending your club for 3 years and I've never spoken to you, but I just wanted to let you know that over the last 3 years, I've bought 7 rental houses. and this person was an immigrant to the country actually. And she had been in the country for 24 years, and had never invested in real estate, but then joined my club and was in it for 3 years. And at around year 1, she started acquiring properties, and she just, sent me an encouragement and said, thank you. And getting notes like that from people, actually helping your investors and hearing back from your investors is what it's all about.
That's great. Yeah, it feels good to have that impact and, to be maybe not giving advice, but you're helping people along that path that you already walked and the things that you've already seen. I guess we're at a pivotal point as well right now, right? A pivotal point in the economy and in the world stage. Without getting too deep into it, I guess, one, how do you approach real estate across the economic cycle? Because you mentioned, you like to have things that are sort of non-correlated with inflation or, inelastic to certain economic functions. How do you approach that? Have you seen that play out? And I guess without prognosticating too much, how do you see this playing out in the next few years as the cycle continues to turn?
Yeah, for the last couple of years, we've had a kind of a slogan, survive till 25. And I think now that we're at 25, some people are saying, I forget what the new slogan is, but it rhymes with 26. So, well, I'm seeing in the market transaction volume picking up. There's more activity happening now than there has been over the last 2 years. Over the last 2 years, we had, in some markets, an 85% drop off of commercial real estate transactions. It was quite precipitous. And now we're seeing more activity. I think we're seeing certain markets that were the first to go up were also the first to pull back, kind of the Sun Belt and Florida. Those have been pulling back quite a bit. The Phoenix area, rents have reduced quite a bit over the last year. In other areas in the Midwest, we're seeing slower growth. I think in 2025, we're going to see slower growth and starting to move towards an uptrend. I don't think it's going to be macroeconomically a strong season necessarily, But I think we do have tailwinds of inflation, of the fact that interest rates have more or less stabilized. There's still a little bit of uncertainty there, but there's certainly they're not. I mean, we had the fastest rate rise in interest rates in recorded, in the history of the Fed in 2020, 2021. We're having the COVID shockwave move through the economy, and we're starting to really level out. And so I think that inflation is going to be a persistent problem for quite some time. And so being on the side of borrowing money and letting that borrowed money inflate down or reduce in purchasing power to buy assets that are cash flowing is still a very strong thesis. And it's going to continue to be a strong thesis in the mid and long terms.
That's interesting you mentioned that. And you asked me about book recommendations last time we spoke. You might find, I don't know if you've read it yet, but Ray Dalio did a really great piece in 2018, 10-year anniversary of the GFC, called Big Debt Crises, or the Principles for Navigating Big Debt Crises. A lot of the principles that you're mentioning, productive use of leverage or borrowing, the deflationary effect of borrowing. So if you're buying dollars, you're paying back in less purchasing power than you bought for. You might find that interesting, and some of our listeners might as well.
It's a big book.
Yeah.
I actually, I'm a geek. I actually had it on my nightstand for the longest time, and I didn't actually get all the way through it. It is a big book.
It is, and but, at least the intro, the archetypical cycle is fairly interesting.
Yeah, there was another really good book. I think the book is just called Debt, and it. I need to look this up, but it gave a 5,000-year history of debt, and it went through different civilizations, how their currency was in effect used as debt, or different iterations of booms and busts over time. Well, Ray Dalio's book went over a lot of booms and busts. That's what a lot of it was, tracing booms and busts and how debt plays a part of that. And so there was another book called Debt that was more of a historical perspective, and went back a lot farther than Ray Dalio's, and was a easier read. But they're both really good books.
Yeah, here, Debt, the First 5,000 Years.
Debt, the First 5,000 Years. That's what it was.
I'll have to give that one a read. I'm always, you saw the stack of books I had last time we spoke, but anyway.
It's really good. It gives you a historical narrative to go along with it. So it's much more storytelling, and it gives you a feel of the people that were using it.
Yeah, and we can talk monetary cycle, we can talk business cycle, economic cycle. I think one of the fascinating things, and coming full circle back to you as well, which is the technology cycle, right? We're entering a new AI boom. We're entering a new technology boom. A lot of our jobs are made easier. I guess, how are you seeing new technology being employed in alternative investing specifically, but affecting the economy more broadly? And how do you see maybe AI specifically and new technology, in generally, helping, hurting, all that side?
AI is very hyped right now, but I think that it is going to transform the way that every business is run. And it's going to be transformed for the better, because AI is, for the majority of jobs, AI is not going to replace people. It's going to give people the tools to do their own job better. And managers that are using AI really need to roll out work programs that train their employees to roll out AI-enabled workflows, because from that point of view, it'll be much more cost effective for those managers to retrain their current employees to use AI than to have AI replace them and to put in place a system that doesn't have a human component. There's always going to need to be human in the loop, as it's called in the AI circles. And so AI is going to completely transform real estate, because you can have anything from automated processes of your everyday, items, just scheduling and emailing and things like that. You can have automated underwriting. Imagine being able to scan and broker OMs and, go through and have an AI pull out all the important information, put that into your financial model, and do it, within a few moments. Any business that's investing can easily scale their revenue pipeline simply by evaluating more deals. And so you're always looking for the diamond in the rough, and the more deals you can go through, the better diamond you can find. I really like the idea of your AI clone or a digital LLM twin. What this is people are using it's called retrieval augmented generation, or RAG, and basically it's the ability. Picture you have an investor data room. You have a particular deal, a multifamily property in Texas, and you want to create an AI that's on that investor portal page that answers questions specifically about that investment. So AI clones are basically you feeding in all your marketing or investor information into an AI. It reads and understands it, and then it's able to talk to you about those documents. And sometimes it'll actually talk to you if you go to a group like 11 Labs, or a group that's able to do voice cloning, can even talk to you in the sponsor's voice, which I've seen people start to do. The sponsor will be there, you click on them, and the AI answers in the sponsor's voice about the particular deal. So there's, and you could use that, for investors who just have a one-off quick question. That way they get their question answered quickly, and they don't necessarily have to set up a deal with you. But there's always going to need to be a point at which the investor can contact you. So these things don't replace human interactions, but they certainly can enhance our ability to get quick information.
Yeah, it's good for analysis, synthesis, but in terms of, we use the word generative AI because it's sort of generating de novo information, but true genesis, I think, is still a bit of a human endeavor, and deal making is still a human endeavor.
Yeah, absolutely. I think that in 2025, for people that are trying to get their deals out there, it's going to be more important than ever that they actually go online and show their face online, because we're starting to see social media just overrun with people generating posts with AI. And they're good, and they're good. But nothing is going to replace.
I wouldn't call them good. Yeah,
they're passable. Exactly, they're passable. But being in touch with people and having that human component, it's going to be important for people to actually go live on social media platforms, show their face, talk with people.
Yeah, I think that's what you've seen your success with yourself. And I think for us at EM, that's what we've seen success for. People always come back and say, being able to talk to a live person, picking up the phone, calling someone, having someone actually care and write sometimes we have typos, but I think that just proves we're not robots, is important.
I often have typos, and I find them about 5 seconds after I send the email, right?
Yeah. The big dough moment. Well, it's interesting. I think it's transformative. It's going to really change the world. It's always iterative, right? It's not this, big watershed moment. But I guess, is there anything that you're particular, other than, the agents that you're talking about, these retrieval augmented generative agents, anything else that you would say is exciting about the horizon, about investing, about technology, and really, I guess, the fusion synthesis of the two?
Oh, one of the reasons why I like being an investor is because it is a journey of constant learning. And since interest rates went up, a lot of people have diversified their strategies, and it's a good time to be, it's always a good time to be learning. And I think right now in particular, as we're starting to see, more pickup in the economy, it's a great time to be learning about all the different types of investment methods that are out there, because almost every person that you speak to has their own take, their own unique angle. And so just constant lifelong learning is I think, an important attribute in today's market.
Lifelong learning, a great piece of advice. Well, Daniel Holmlund, founder of Alternative Investing Club, thanks so much for joining me today.
Thank you, Daniel.
That's it for this episode of Multiple Perspectives. Thanks again to Daniel for co-hosting the show, and Daniel Holmlund for being our special guest this week. If you enjoyed the discussion today and you want to hear more about what Daniel Holmlund has to say about personal finance or alternative investing, you'll find links to his work in the show notes for today's episode. If you want to learn more about real estate investing and the opportunities that we have on the Equity Multiple platform, we've got links for that too. Thanks for joining me here once again on Multiple Perspectives. I'm David Lofgren, and as always, you can let me know what you think of the show via our email, multipleperspectives@equitymultiple.com. See you next time.